Hi, everyone. This is Tyler Morris from the Brown Wealth Management Group. Over the last few weeks, we've seen mortgage rates sit at historically low levels, and we've had many clients contact us to see if they could potentially benefit from refinancing their mortgage. And while it's easy to think if I can get a new loan with a lower rate that it's a good idea, there's actually a number of factors that you should consider before making that decision to refi. So a good starting place would be to contact the lender to see what's available in the marketplace. They'll make a few key assumptions around your specific property, your income, and your credit. They should be able to help you understand if you could save money with either a lower monthly payment, a lower interest rate, and maybe save money by paying less interest over the life of the loan. You're going to want to make sure you ask your lender, what is the cost to refinance my mortgage? And they should be able to provide you with a good cost estimate. And this is going to be particularly important for owners of larger jumbo-sized mortgages, as we've seen that the cost of refinance can vary from bank to bank due to different appetites for risk that they're willing to take. Then the next thing you're going to want to ask is, well, how long do I plan on staying in my home for? And because there's this upfront cost that you have to pay for to refinance your mortgage, it might not make sense if you're not planning on staying in your home long term. The third thing that you should look at is, well, if I'm looking at a refi, what is the age of my existing mortgage that I already own? This is important because when you refinance your mortgage, it's important to remember that the timeline and the amortization schedule gets reset, thus potentially pushing out the maturity date on the new loan. So you could find yourself in a situation where I have a new mortgage that I refinanced into, I have a lower interest rate. However, I'm spreading those payments now over a longer period of time because I reset the clock. And what could happen is you pay more interest over the life of the loan due to you refinancing. Other things to consider would be maybe I could benefit from refinancing into a different type of mortgage. So one example of this would be if you have a 30-year fixed rate mortgage, maybe you could benefit from refinancing to a 15-year mortgage. You'd get potentially a lower rate, paying less interest over the life of the loan for a shorter amount of time, and maybe you can keep a payment that's within the ballpark of what you're currently paying. Another similar example would be for homeowners who aren't planning on staying in their home long term is looking at an adjustable rate mortgage. An adjustable rate mortgage allows you to lock in a lower rate for a fixed number of years, such as 5 or 7 or even 10 years. So those tend to work well for folks who don't plan on staying in their home forever. The last thing that you should consider that I wanted to discuss with you today is perhaps there's an opportunity to consolidate other debts that you might have. So good examples of this would be if you have high interest rate credit card debt or student loan debts, for example, there might be an opportunity to consolidate those as you go through the refinance process. So if you're interested in looking at this for your specific situation, feel free to contact Brown Wealth Management and we can run the analysis for you to see what might work and what won't. And if you have any questions, feel free to reach out. Thank you so much for your time.